Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Semiconductor technicals, macro risks, and CTA positioning. This video presents a direct informational narration of the source document. So, kicking things off today, the four major indices closed nearly flat. And interestingly, the semiconductor index ended its 18-day winning streak. It fell just about 1%, with 24 of its 30 components dropping. The only real support keeping it from sliding further came from strength in Micron and NVIDIA. Here is a quick look at the structure of this explainer. We'll be walking through semiconductor technical levels, specific AMD charts, the geopolitical impacts on oil, Microsoft's restructured OpenAI agreement, their earnings volatility, and finally, we'll wrap up with algorithmic CTA positioning and market breadth. Let's dive right in. Section 1. Semiconductor Index Critical Levels. Looking at the semiconductor index, we're seeing a really clear topping pattern. This is heavily influenced by month-end pension fund rebalancing, where they're essentially selling off outperforming stocks. Because of that dynamic, this current pullback, it's actually structurally logical. Now, the intraday dynamics are pretty fascinating. We actually saw active buying stepping in to absorb that passive pension fund selling. In fact, the index recovered nearly half of its intraday drop, which is a strong signal that this sell-off definitely lacks complete consensus. So, how do we know if this is just a temporary dip or the start of a broader trend reversal? Well, we have to keep a close eye on critical ETF support levels based on closing prices. The SOX hit a low of 448.93, while the SMH hit a low of 497.74. That SMH level is remaining slightly higher relative to past days, which means we'd really need to see a break below Friday's low to actually confirm a breakdown. Moving on to Section 2, AMD Technical Breakdown. Zooming in on specific components, AMD's price action is pretty much mirroring the broader semiconductor index right now. It's resting at a highly sensitive technical juncture. For AMD, that critical low rests exactly at 328.81. If we get a confirmed break below that level, it exposes a price gap all the way down to 309. To put that in perspective, we're talking about an estimated 10-point pullback risk here. Section 3, Geopolitics and Oil Prices. Shifting our focus over to macro geopolitics, Brent crude oil has been experiencing some real volatility, dropping from a close of 109 down to 102. And out in the Middle East, negotiations basically showed no progress. Iran proposed a three-step plan that would delay nuclear talks, the U.S. completely canceled an envoy trip to Pakistan, and U.S. Secretary of State Rubio explicitly rejected Iran's demand to control the Strait of Hormuz. Now, the timeline the market is closely anchoring to revolves around the 60-day limit of the U.S. War Powers Act. That clock started ticking around February 28th and is set to expire right around May 1st or May 2nd. That's a hard deadline dictating that any further military escalation requires congressional authorization and funding, though it is worth noting that a one-month withdrawal extension remains a possibility.
Here's why this matters. As long as the situation in the Strait of Hormuz remains unresolved, those sustained high energy prices are generating a continuous right-tail macro risk that ultimately compresses corporate margins in your traditional sectors. And that's a dynamic we fundamentally have to differentiate from short-term semiconductor speculation.
Just briefly touching on domestic events, the overall financial market reaction to the recent presidential shooting incident was observed to be relatively flat, which is quite muted, all things considered. Section 4, Microsoft and OpenAI restructuring. Bouncing back to tech fundamentals, Microsoft shares actually recovered from a pre-market dip below $410. This bounce followed the announcement of an amended and much more simplified operational agreement with OpenAI. So, what are the new terms? Well, Microsoft remains the primary cloud partner with timed exclusivity, meaning OpenAI products launch on Azure first. Furthermore, Microsoft retains non-exclusive IP and model licenses until 2032. They are also officially stopping their revenue share payments to OpenAI. On the flip side, OpenAI will actually continue making capped proportional payments to Microsoft until 2030. Section 5, Microsoft Earnings Volatility. Looking beyond the OpenAI restructuring, Microsoft's core catalyst right now is its April 29th earnings report. This is going to be heavily weighted toward forward guidance on AI capital expenditures, and we're expecting some absolutely crucial updates regarding their 2027 CapEx, somewhere between their Q2 and Q3 reporting. Let's look at the options pricing for the nearest May 1st expiry. It implies a $30 move from a $425 base price. That maps out a 68% probability of hitting an upside target anywhere from 455 to 498, or seeing downside risk dropping below 395. To break outside that $30 boundary, you would basically need a 31% low probability black swan event to unfold. Concurrently, NVIDIA just put up 2 consecutive days of 4% gains. However, the source document strongly cautions against chasing this short-term rally, as it could easily be dragged down by the broader index correction. That being said, valuations do remain reasonable for investors planning to hold into January 2027 or 2028, assuming they got in at previous entry points around the 18 to 19 range. Section 6. CTA Positioning and Breadth. Finally, an analysis of systemic market positioning reveals something quite important. Algorithmic trading flows, they are currently completely exhausted on the buy side. Looking at global CTA long positioning, it has stabilized at a massive $111 billion. To put that into perspective, that represents roughly 75% of pre-conflict levels. And if we look specifically within the S&P 500, CTA long positioning sits right at $32 billion. We saw $20 billion of that purchase just last week alone, and a staggering $50 billion over the past month. So what does this all mean? Well, because algorithmic buying is completely exhausted, the upward CTA pressure is effectively at zero. However, the downside algorithmic sell trigger remains safely distant around the 6,700 level. For that to even activate, it would require a severe daily drop, rather than just those gradual daily slides of less than 1%. The document concludes this explainer with a stark fundamental observation. It states that the market's extreme top-heavy concentration is structurally unhealthy, and the overwhelmingly poor market breadth simply cannot be sustained indefinitely. It definitely leaves you wondering how long the current market structure can hold up.